Hey, good afternoon, everyone. Nice to see some familiar faces in the crowd. Hopefully, our goal for the session is to keep it high energy. We'll leave about 10 minutes for participation at the end. Would love for folks with burning questions to, if not shout them out, make it known that you need to ask them so that we can wake up the pulse of the room a bit and lead into a great afternoon. So I'm Jason Zaylor. I have lead fintech partnerships at PwC. But more importantly, I'm surrounded by a cast of colleagues here that are experts in the field that'll bring a unique perspective to just how blockchain is going to impact the banking industry. It's a question we've been talking about for a few years now. I think most folks here either work on it, work towards it, or aspire to do one of the two. And we're going to get a bit deeper on what it means today. So I'm pleased to introduce my panel, starting with Eric from Abra. He will be providing perspective as a practitioner. Then you have Matthew Sewell, one of the leaders of BNP Paribas L'Atelier here in San Francisco, discussing from a bank perspective what this all means. After Eric, we have Ben Lozano, who's starting an exchange focused around these technologies, and that's a really interesting take on things that we'll look forward to hearing. And then finally, I think you just saw a pretty impactful presentation from Dominique at String Labs, so we'll get sort of into the details with these gentlemen. And answer your questions. So with that said, let me kick it off by posing the following question. We've been hearing about what's going to happen with blockchain and banking for 2 to 3 years now. What are you doing to make a difference? And whoever wants to take that can go first, and we'll kick it off from there. Ben, you have the mic.
I guess I can start. Yeah. So my name is Ben Lozano. I'm the CEO and co-founder of True North Business Exchange, and we're building the San Francisco Stock Exchange, or more specifically, the San Francisco Stock and Bond Exchange. Wait, I know that there was a San Francisco Stock and Bond Exchange before, so let me just clarify, we're not that one. That one consolidated with the Pacific Stock Exchange is no longer in business. I'm trying to convince FINRA of that right now, actually. The San Francisco Stock Exchange is the world's first public marketplace for buying and selling U.S. small business financial securities, and if we have it our way in the future, we will have replicated a series of investment banking services to facilitate basically a public marketplace for small business financial securities. So what does blockchain mean for, what's the title of this? For the banking industry? If we have it our way, we will have used blockchain as one crucial, but not the whole thing, one crucial module in our system architecture to support the San Francisco Stock Exchange. And if we're successful, we will have put the commercial banking industry out of business.
Perfect. Let's throw it to Eric next. So what are you doing to make a difference?
Sure. So my name is Eric, and I lead business development at Abra. So Abra is building the world's first fully interoperable mobile money application that allows you to send money between any two smartphones on the world. And that could also be used to pay merchants or for businesses to make payments directly to the smartphone. The only way to actually solve that particular problem is by using, in our particular case, a digital currency. And what we aim to do, consequently, is to extend digital payment services to any person in the world that has a smartphone, whether they have a bank account, don't have a bank account, whether they're using cash or not using cash, and to be able to send money to a merchant, to another person, or receive payment by only knowing their phone number.
Wow, really interesting stuff. Matthew?
Hi, so thank you, Jason. So my name is Matthew, so I'm leading the fintech effort for L'Atelier, which is the innovation lab for BNP Paribas Group, based in San Francisco. Our job, in fact, is to identify disruptive technologies and the impact on business model for banking and financial institutions. So BNP has been working for a couple of years now around blockchain uses in many different fields. It's from trade finance to cash management to settlements, etc. We started, in fact, just earlier before Bitcoin regarding virtual currency. We had a lot of businesses around digital assets, and it was very interesting from our perspective, in fact, to use different technologies. And we have been very enthusiastic about partnering and working on different use cases. We'll discuss later on the panel, but it takes time, in fact, to get things rolling on. But I think it's a very interesting time for everyone.
Yeah, hi, I'm Dominic Williams, and working on a thing called Definity, which addresses some of the performance limitations in blockchain computers. String Labs, as a company I work for, is a founding member of the Enterprise Ethereum Alliance, which works mainly with investment banks to create technology for shared ledgers, and also work on this thing called Phi, which is aiming to create a decentralized commercial banking replacement.
Thanks for that intro, guys. And what I want to do first is sort of distinguish. You heard very different answers on how each of these people are working to incorporate blockchain into banking. So the first piece I want to cover is the technology side, particularly with Dominique and Eric. One of you, I believe, is using Bitcoin-based tokenization, and the other on Ethereum. So hearing the approaches, and then tying in Matthew to learn what banks are looking for when they come across these providers or new solutions approaches in their world. And then we can tie that all together by turning it to Ben and hearing how securitizing some of these opportunities in San Francisco will create a new marketplace. So I'll let either of you guys start first about your approach and why.
Sure, so I can start since I have the mic. So the only way to actually solve the problem that Abra set out to solve, which is the ability to send money between any two smartphones, is by using digital currency. And the reason that is the case is because as soon as you take custody of someone else's money, you become a bank. And as soon as you become a bank, you can only operate in a place that you have a license. The only payment networks in the world that are actually able to operate in 196 countries are the payment networks that never touch other people's money. So what digital currency allows us to do is for the funds essentially to be stored directly on the phone. So when I'm making a person-to-person payment or a consumer-to-merchant payment or a merchant-to-consumer payment using Abra's system, Abra itself is never in the funds flow. We never touch the money, we never take custody of the funds, and that it can only be enabled through digital currency. Now the second thing that Abra's realized is that while Bitcoin as a currency, as an asset, as a commodity, whatever you want to call it, is extremely interesting. If we go out onto the street and ask someone, do you want 1,000 Bitcoin? Maybe not in San Francisco, but let's say the average street in the world, and say, do you want 1,000 Bitcoin or do you want $1,000? 9 out of 10 people, if not 10 out of 10 people, are going to say to you, I want $1,000. Now, so what Abra's essentially done is we've abstracted out entirely the Bitcoin from the technology so that when you open up our app, you can have 1 of 53 currencies that we're currently hedging. So when you're making a deposit into Abra, what you're in fact doing is you're purchasing digital currency, and we're locking in a smart contract hedge, which essentially means it will stay forever. Or when you're actually withdrawing, doing a cash out of our system, what you're in fact doing is you're selling your digital currency. We chose Bitcoin because at the time that we started the company, it was the only readily available, call it liquid digital currency that has liquidity anywhere in the world. And also that allows for smart contracts to be enabled.
Got it. And in your perspective, how, keeping in the theme of the panel, as you grow, are you able to work with incumbent institutions?
So in my previous life, I worked twice as a corporate venture capitalist for 2 large financial institutions, or one financial technology institution, another large financial institution. And the reality, I think, is when disruptive technologies come, there will be first movers, non-movers, and ultimately laggers. In this particular case, I think that the vast majority of financial institutions that are embracing Bitcoin-based digital currency technology are the ones that are not global financial institutions. And it's ultimately the ones that recognize that the correspondent banking system is more or less broken, or they're hostage to the correspondent banks.
Right.
And as a result, what we're finding is that the national banks, those that are operating in one country, are the ones that are the fastest to move with this technology.
Got it. All right, let's come back to how the banks are moving on the technology in just a second. But first, I'd like to just turn to Dominique to say, hey, as the other practitioner, how did you come up with your approach? And to answer the question of how is it changing banking?
Well, you know, Definity just came out of personal interest in the maths and so on, so I've been working on that for some years. But, you know, the maths behind Definity is applicable both in the public setting, you know, creating a public chain, and both within, you know, sort of bank industry via consortium chains. Mainly, it will allow the creation of shared ledgers that have more capacity and are more robust and so on. In relation to Phi, I mean, Phi came about because I'd spent actually, a couple of years trying to find ways of creating price-stable tokens on top of things like Ethereum, and always finding that there was some kind of failure mode and never being satisfied with the designs. And in the end, read a book by Bank of England, some Bank of England guys called Where Does Money Come From? And suddenly realized you could decentralize fundamentally decentralize the commercial banking system, and through doing that, you could create this crypto fiat, which would, provide a lot of benefits. For example, in the case of Abra, in order to move money around, you have to hedge Bitcoin, which is extremely expensive because Bitcoin is so volatile. So you get these things called roll costs, and probably in the long run, although in the short term it's a great way of doing things to get things going, long term it's not going to deliver the kind of cost benefits that people want to see from crypto. So we want to produce what we call crypto fiat, where people can get a crypto equivalent of the local fiat currency, right? And this will enable all kinds of financial applications that are just totally impossible at the moment.
Let me just not let the opportunity pass to ask Eric to respond to the strategy comment made that the model that you're pursuing is more costly.
Our cost to hedge is 1 basis point a day. So my math is pretty simple, but that's pretty cheap. So I would say it's not so much an agreement or disagreement, it's just our cost to hedge is 1 basis point a day. As far as this notion of nationally issued fiats, I think it's very interesting. But similar to the way the vast majority of international funds are clearing in the US dollar, there has to be a currency of reference. Will Bitcoin be that currency of reference? Will Bitcoin be the one that allows for interoperability between the digital yen and the digital renminbi and the digital dollar? I don't know. But the reality is that I do not see the Bank of England building a consumer-facing application. They will issue a currency into the system,
right,
and it will be technology companies and startups and others that will build the consumer-facing applications on top of them.
Sure. So I think these two could probably go back and forth all day. I want to just pause briefly and come back to it in a few minutes. So, yeah, all right. Well, if that's the case, I was going to ask you a question. So the big thing is, if you're looking at two different approaches to tokenizing currency, moving money, whether it's on the custody side or in these guys' cases on the institutional or investor side, I want to try to tie the conversation together of how this involves the banking stack, and then go to what some prognostications and predictions can be going forward. So Benjamin, could you talk a bit about, building on what they've said, how your going to market is going to work, and then we'll ask Matthew to provide his expert opinion.
Sure. So, there's a lot of places to take that. I guess just to explain, we're on a private Ethereum network, and the reason we did that is because of the use case problems we had when trying to build a financial exchange. With Bitcoin and also on public Ethereum, you have a lot of latency, but it just didn't fit our use case. And so I think some of the things that the new startups that are out there are discovering is that, like, the promise of the technology is great, but once you get your hands in the mud and start playing with it, you're going to run into some problems that maybe don't fit your use case. And the reason why I like Ethereum is because it gives you that kind of flexibility, the fungibility. For instance, we hacked out 14 seconds of latency on Ethereum down to sub 1 second, because that's what, to have an exchange with trading of securities required. And so maybe one thing that the banking technology stack, as it evolves, will mean is these kind of new creatures of blockchains that are hybrids of the foundational layers, whether it's Bitcoin or Ethereum in the case where it lends itself to maybe a little bit more flexibility.
Got it. Thanks. That makes sense. So, Matthew, you're working on behalf of a large global institution, one of the biggest in the world, and you hear three differentiated approaches to different use cases on the stage, but all touching on new technology and all needing at some point to interact with either yourselves, your technology, or your customers. What's your reaction to the approaches that these folks are taking, and what's BNP doing globally to engage with blockchain?
It's a good question. For me, it's I will just maybe make a step back. I think from a financial institution or On that, there is a lot of discussion regarding basically the role of currency or money. There is a lot of question around that. There is a lot of question around, I would say, centralization, decentralizations, and is a financial institution as a good place. What I would phrase is financial institution or financial, I would say, services in general is a very intermediated market in a lot of stuff. And it's always very interesting from a banking perspective. We are one part of the value chain, but not the only one. In some infrastructure, as you may know, the banking industry, like the Visa of the world or the networks or the settlements, is always kind of a co-organizations company. You have some stuff. The premise, in fact, could be some decentralizations, and that could be meaning a lot of things. That being said, from a banking perspective, you have always a question of regulations, and that's probably where we are maybe a little different than startups, because we can take less risk regarding that. That being said, we are very interested from any kind of technologies that could simplify from a cost perspective, speed perspective, whatever, from our client perspective. Just to give you one example, we did some stuff on regarding cash management with 2 of our clients. So moving money in between banking BNP Paribas accounts across countries. It was with Panini and another was with Amcor. It's working well. It's solving some of the issues we could have. It's still in their POC or pilots, meaning it's not like you have live production, but it's something we are accustomed. What we are saying with Jason preparing this panel, we started, almost all the financial institutions started probably 2 to 3 years ago to acknowledge that there was some potential opportunities in the technology uses. 3 years after, where we are standing, a lot of financial institutions started with labs investments. You could see, in fact, a lot of players receive investment from banks, NASDAQ, or other financial institution players. And US is looking at, I would say, from full deployment, probably the next 2 years. That being said, everything that is involving multi-stakeholders, meaning that you have cross-borders, different institutions, different regulators, by nature is taking time. So it's a different approach. It's moving slowly, I would say, compared to startup world. It's probably where the banks are looking, in fact, on both sides, what would be feasible.
It's interesting to hear that 3 years down the road that obviously the regulatory impacts are having an effect at the institutions, but I think they're also having an effect at the startup or innovator level. I know that for us, for our clients in this space, we've helped with a lot of custodian banking use cases, working with different providers. We've worked on some cross-border settlement and some trade execution. And the one theme across the board is that you have innovation groups at these large FIs that want to take the chance and build something and have to then prove it to the business unit. And so one of the things we always talk about is integrating the business unit and the innovation center so that the goals become the same and the KPIs become the same. So I'm curious for all of you in your journey to this point, where have you worked successfully when it has been with institutions, and where have you not worked with them when it comes to going to market? And Eric is reaching for the mic, so I'll start with you.
So as both a former consultant and a former corporate venture capitalist, I would say inherently a business unit manager is measured on his or her ability to deliver on near-term revenue. And if you're a business manager in the room and that's not your KPI, don't ever leave your job because you have an amazing opportunity in front of you. But if you're the average business manager, you're measured on short-term gain. And innovation is inherently not going to happen in the short term. So I would actually slightly disagree with this notion that you should involve business units. I think that forward-thinking institutions have figured out a way to isolate near-term KPIs from the broader strategic questions of what is banking going to look like 5 years from now? What is payments going to look like 5 years from now? What business do we want to be in 5 years from now? What does it mean to be both disrupted and enabled through emerging technologies? So in our particular case, we don't work actually directly with financial institutions because we operate as a software provider. So we work with liquidity providers all over the world, in this particular case, digital currency exchanges. And it's in fact them that are working with their financial institutions. The irony that I think in our particular business model that I see time and time again is that the Bitcoin exchanges are trying to open up bank accounts. And they have bank accounts with treasury services and other cash management services built on top of it. But because they mention the word Bitcoin, the vast majority of financial institutions can't really wrap their head around the business model. And yet, the ones that do wrap their head around the business model do realize, if this works, I will no longer have to depend upon Wells Fargo, Citibank, HSBC, Standard Chartered for my correspondent banking. But if this doesn't work, in the grand scheme of things, I'm just opening up another corporate account.
Yeah, Benjamin, how's it been for you?
Just comment on that, though. It does seem like a lot of time there's a little bit of a tendency towards hyperbolizing the radical impact this will have for the tradition of payments and banking service, where it seems like more often than not, I find that like financial institutions, at least the dominant players that have been there forever, we may not even know their names in some cases, like State Street or whatever. Like, they've been here before. They've seen this stuff in mobile. They saw it in cloud, and they understand that there's going to be maybe a tendency, at least potentially, towards one industry standard, and so they all start to kind of put the smart money up behind one thing. You see this, for instance, with Chain and Visa that married early, where, you know, like, Visa's not going down without a fight. Like, they're going to stay there. So I think that there is maybe a tendency sometimes for us who are like maybe like startup entrepreneurs to like hyperbolize that in five years everything's going to be, and I know you weren't necessarily saying this, but like in 5 years, 10 years, everything's going to be radically different. I don't think you're going to see massive innovation like that. You're going to see more integration between the traditional financial institutions, and I say this as I know that I'm baiting you, Dom, because 10 years from now, the financial world is kind of going to look entirely different. See, you weren't going to have us pick a fight, and I'm going to try to now, so go.
You know, I think that if you look at blockchain as Internet 2.0, you can draw parallels with Internet 1.0, and I suppose we're kind of, you know, in 1996 or something like that, right? So was that when Amazon was founded? So, you know, yeah, it took like, you know, 10 to 15 years before you really saw the full disruptive impact, right? But you can ask, you know, high street shops how they feel about Amazon now. You know, it does eventually. These fundamental shifts in technology do begin to exert very powerful effects, disruptive effects. So I think it's true that, you know, there is a lot of hyperbolizing and exaggeration, you know, about how fast this stuff will create an impact. Personally speaking, I'm not that bullish on cryptocurrencies per se. I think that, you know, currencies that are volatile, you know, have volatile value aren't really currencies. And there's all kinds of interesting things that I'd like to be able to do in decentralized finance that I can't do today because, you know, the currencies are too volatile. I mean, I'll give you an example of how this impacts things. You know, there's a lot of interest in prediction markets at the moment. And there was a new prediction market called Gnosis that just launched around a crowdfunder, got a $300 million valuation and so on. And you know, one of the kind of challenges it's going to face is that, sure, people can use their cryptocurrency to place bets on future events, and there's lots of people that want to do this, right? The difficulty is that the currency that they'll use to place bets on these future events is far more volatile, right, than the probabilities of these events occurring or not occurring, right? So you have a kind of fundamental problem there that, yeah, sure, you know, we can create a prediction market in cyberspace, and people can place bets on future events using cyberspace money, ETH in this case, right? But at least at the moment, you know, I mean, ETH has just gone up 20 times in the last month or something. There's huge volatility in the cryptocurrency, and it's going to make it very difficult for businesses to hedge future events. For example, a business might want to hedge the weather, for example. Like a farmer might want to hedge against a drought or something like that, right? The problem is that if he has to buy ETH and collateralize his bet on the weather with that ETH, you know, the ETH is going to present far more risk to him than the hedge is going to benefit. So I think you know, we've got a long way to go, and I think on the one hand I'd agree that, you know, there is a tendency towards hyperbolizing things, and especially cryptocurrency. But I disagree, I think, on the long-term potential. I think it'll be completely transformative, more radically transformative than Internet 1.0.
So as one of the incumbents on the stage and someone that works with hundreds of them around the world, and there's a lot of other folks like myself in the audience and Matthew on the stage, I kind of want to refine what you just said and ask Matthew a question. Is the transformation going to be visible to the everyday banking participant, or is it going to be visible to bankers and technologists? Because I think that when 3 years ago, if you asked the question, it was focused somewhat on the consumer and on the end user. And it's been my opinion from our clients' needs globally that it's much more focused on the industry and on the technologist. Have you seen the same thing at BNP?
Yeah, so I would say the banking industry in general, there is consumer-facing and very B2B business lines. What I would say is, if we are taking the analogy from the internet and different technology disruption, potentially there is disintermediation, but always in this kind of cases, there is reintermediation. And the big cases for everyone for reintermediation will be the new Amazon, Netflix of the world. And that's maybe from a remittances perspective, could be Abra, it could be some others. What is different, I would say, is the incumbents in the financial services industry are the marketplace players. You're taking NASDAQ, you're taking Visa, etc., are already aware that they could have some disruption and they are already betting on it. That's not saying that there will be not new players. That I'm just saying, in fact, there is a lot of interest, and the good news for the incumbent is as the adoption of technology is taking a long time, it's much more easier from an incumbent to just make it smooth. That being said, I think there is a strong push for everyone to look at different models, but again, because of the question of regulation, etc., it will probably slow down everyone, including the incumbents, and that's probably a very good cases for incumbents to make the transition working. What you're seeing, in fact, a lot of, for some cases involving financial institutions, you have a lot of corporations, from investment to partnerships. You have many, many different consortium or standards that are created and competing, but that's always the case when you're looking at different technologies. At the end of the day, I think the market is growing, which is great for everyone, and after it's just a question will win, but it's very soon to tell that.
Perfect. So what I want to do, and Eric, did you want to jump in on that?
I just wanted to comment on one thing that Benjamin said earlier. Technology solves a use case. And one of the fundamental challenges that I think financial institutions typically have when it comes to innovation is this a slightly easier conversation in the boardroom to say, what's our blockchain strategy? Versus, what is our strategy? Who do we want to be? And perhaps recognize that the fundamental question might actually be, should we have branches? Should we not have branches? Should we be in the credit card business? Should we not be in the credit card business? And we're in a blockchain discussion, but ultimately, blockchain is one of many issues that large financial institutions need to be thinking about. I happen to work for a company that's trying to solve a particular use case, and we're using a technology to solve that use case. But too many companies and too many large organizations have an obsession with having a discussion around the technology rather than asking kind of the heart-to-heart question of, what am I solving for?
That's a great point. And with that, why don't you guys, when we open up to the audience, to ask us what we're solving for, anything else on your mind? We've got about 6 minutes of Q&A or AMA, depending on how you want to play it. Do we have a mic runner for this side of the room?
Are we going to see each financial institution having their own flavor of blockchain and cryptocurrency, or something like Ripple signing everybody up?
Who wants to take that one?
So the way I'll answer this, sorry, this is a little bit closer. There are approximately 13,000 financial institutions in the United States alone. Ripple is not going to sign up 13,000 financial institutions. No consortium is going to sign up 13,000 financial institutions. So no, I do not think that you'll see every financial institution wholesalely migrating to any particular platform. And this is just the United States has 13,000 financial institutions. Will you likely see large financial institutions that are inherently already tied together through the businesses that they're engaged in, whether it's trading, whether it's securities, whether it's cross-border trade finance, whatever it might be, beginning to look at this technology, yes. But while the market is consolidated, there's a massive long tail of financial institutions that are asking more fundamental questions such as, what am I supposed to do with my branches? And I don't think that blockchain in many regards should even be on their strategic agenda, because they have more fundamental questions to answer, which is, will I exist as a credit union 5 years from now?
Just briefly, I think there's 3 options directly to your question. One, there's one major industry standard. There's been a couple protocols that have raised massive amounts of venture capital by arguing that, ostensibly very persuasively. Secondly, you could have a set of loosely linked blockchains that are using Solidity or some other foundational language, so that allows for the easy migratability, right? Like train tracks with picking up different cabooses and moving from one place to the next. And the other is that you have just pure heterogeneity where there's just a ton of different blockchains, none of them in any way related or interoperable.
Yeah, I think it's, very important to see there are going to be two different worlds, right? One world involves the enhancement of the existing financial system using blockchain technology. And that world will always be fully regulated. Wherever you have a company, a financial organization that has, it'll be incorporated somewhere, it exists in a jurisdiction, it's a member of various financial treaties, right? And this thing will always be subject to regulations, right? It will always be a creature of regulations that exist today. And these things will be loosened somewhat to allow the effective application of blockchain technology. But essentially, you're looking at the enhancement of the existing system. On the other hand, there'll be a different approach where new kinds of financial system emerge that are fundamentally based on protocols. Ripple isn't a protocol. They call it a protocol, but fundamentally, it's a centralized system that rests on Ripple, the company. It's subject to regulations. When they did various things, they got fined and so on. A protocol is just a piece of math, right? Like Bitcoin fundamentally is a protocol. There's no organization you can go to regulate. You can try and regulate the exchanges, you can regulate the exchanges that people use to convert Bitcoin into dollars and things like that. But, fundamentally Bitcoin's a protocol. And we're going to see the emergence of a new kind of financial institution that isn't an institution at all. It doesn't exist. It's just a piece of software. It's just an algorithm. And that's a much more fundamental shift that I think people aren't really aware of. And that's what's really going to transform the finance industry. It'll take a while, but we're going to see a migration, for example, of financial markets to decentralized exchanges. And you can see this happening already with ICOs. The action right now in fundraising is not in venture capital. Much more money right this moment is being raised through ICOs using token models, right? So the shift is already occurring, and there's already, I know lots of people working on fully decentralized financial exchanges. I've written on the cryptography necessary myself, describing how it can be done. And these things will enable people to buy and sell tokens related to these systemized businesses. So this is a much, much more fundamental shift. And it's not a question of, the regulator says that the exchange has to be regulated. Well, whose jurisdiction is the exchange? The exchange will only exist in cyberspace, all right? And it'll be international in nature, and lots of people from around the world will participate in this exchange, and those individuals will be regulated, of course, because they exist in a regulated jurisdiction, but the exchange itself is just a piece of math, fundamentally, that looks like an exchange, and it exists in cyberspace. These new financial systems that are based entirely on protocols are where the real disruption is at, not in the enhancement of the financial industry through the application of blockchain technology. So I think it's a very important distinction to carry with you when you're thinking about this stuff.
Thanks. I think if we can keep them quick, we'll go two more. So let's go there and then here. Just to repeat the question, it's what are the key roadblocks with consumer adoption that Eric's struggling with to get consumers onto the Abra platform?
I don't know if I would qualify it as struggling. The challenge that Abra will have fundamentally will be enabling liquidity in many locations as possible. So right now we have presence of tellers in, I think, 150 cities in the world. But we actually only have bank integration here in the United States and in the Philippines. So as a result, the vast majority of consumers that are early adopters are coming in through the system and out through the system using banking rails that are local to their country. And in order to expand the options is fundamentally really an engineering challenge for us, just to get it integrated to as many exchanges as possible, as quickly as possible. And that's what we believe, and that's what we're seeing is going to get sort of the flywheel going for us.
Perfect. Let's just do one more quick one. Yeah. All right, perfect. So will open software be developed without structure based on what's happening on Dominique's previous answer? Can you keep it short? Because we're getting the hook. All right.
I will. Sure, people have to reimagine how a business might work as a software, they entirely as business logic. And, the tokens are an integral part of that business logic. And typically they'll grow in value as the business logic becomes more successful. But, the business logic is autonomous. It's installed on, a blockchain computer, which exists in cyberspace. In a funny kind of way, the business logic becomes an extension of the protocol that makes this blockchain computer operate, right? So the business really is just a protocol itself. Nonetheless, it involves lots of different actors, and it has a token that will grow in value as the thing becomes more successful. And because these tokens exist in cyberspace, they're not issued by a company, they haven't got an organization behind them, they're not securities in the traditional sense, and they can be traded for other tokens, and some of which may be cryptocurrency tokens, for example, within cyberspace. So it's a fundamentally different model, and it's exploding at the moment. Hundreds of millions of dollars being raised, it'll be billions of dollars soon.
So
Absolutely.
I would encourage both of you guys to continue the conversation on the sidelines. It can be a robust debate. Really want to thank the crowd for being attentive and focused during the panel, and we look forward to being available to chat at the next break in the back of the room. So thank you all very much, and thank you to our panelists.